Michael Burry has 43% of his portfolio in Molina healthcare stock, ticker symbol MOH. He even stated that long MOH stock and long Palantir puts like peanuts, butter, and bananas. And to me, it was very funny. But he seems to have a lot of conviction in Molina healthcare. And the stock is down 47% year to date. So I'm going to talk about the stock, let you know if it's presenting some kind of a generational buying opportunity, as it's not alone. Centene is down a lot, United Health is down a lot, Humana is down a lot. A lot of those insurance stocks are having their 2008 moment, and I think they could be offering an amazing opportunity. Now, Molina Healthcare is an insurance company in the United States. 88% of their business comes from Medicaid, 7% from Medicare, and 5% from the healthcare marketplace, or healthcare.gov is the website here in the US. The premium revenue for them has grown really well over the last 5 years, from 18.2 billion to 38.6 billion. Pretty amazing. Same thing with earnings per share, from 11.23 to 20.42, and that's really good. But very recently, they're facing the same challenges that United Health and Centene and a lot of those companies are facing, which is a higher medical care ratio. The medical care ratio in the third quarter for their Medicaid business had jumped to 92%. The average was 87, 88, maybe 89% at the most. It jumped to 92% due to higher levels of utilization. The Medicare MCR for the third quarter jumped to 93.6%, really high. And that's also because of higher utilization. For the marketplace, it jumped to 95.6%. This is really bad. But the company is doing something about it. They said, we are repricing the marketplace book of business to reduce exposure and restore margins. Our 2026 rate increases average 30%, ranging from 15% to 45%. So they are raising prices in a major way for them to make up for the higher medical loss ratio. And they also have reduced their county footprint by about 20%, and they have exited a lot of markets that are unprofitable for them. United Health is doing the same thing, and a lot of those insurance companies have not priced their plans well enough to cover the losses. So they're increasing the price of their plans for them to make it up back in 2026. So the issue is mostly within Molina Healthcare's control, and the management is trying to do something about it. Now, for their guidance, they're expecting $14 in earnings per share for 2025. And they said for the 2026 outlook, they expect it to be the same of 2025. So for 2026, we can expect about $14 on a worst case scenario, very conservative in my opinion, in earnings per share, which would equate to about 11 times earnings. The chart here says 12 times earnings, but the actual one is about 11 times, with an average PE ratio of 15 times earnings. So you're buying it well below the average PE. But I believe the $14 in earnings per share is very conservative. And the reason why I believe that is from the management team themselves. And this is mainly because of the states raising their rates. So they have not raised their rates at an appropriate level in a while. They're going to raise their rates again in 2026. If they do raise them a little bit better than they did before, due to all those companies facing a higher medical loss ratio, it could cause a massive tailwind, unexpected tailwind for Molina Healthcare. And they said rate increases beyond our initial assumptions create significant earnings upside, as each 100 basis points of MLR yields $4.50 of earnings per share. Their earnings per share target of $14 on 11 times earnings is pretty much on the worst case scenario. It expects that their Medicare business and marketplace will be break even. They may not be break even. Maybe the states will raise their rate a little bit more, and it could cause a massive jump in earnings per share for Molina Healthcare. So you're pretty much paying 10 times earnings on the worst case scenario. And the best part about it is Molina Healthcare is actually buying back a lot of stock in the sell-off. My stock, which is United Health, is not doing that. The company is trying to reduce their debt, and they're not in a good position to buy back stock. Molina Healthcare is buying stock like never before, and they plan to do much more of that. And they said in this quarter, we have repurchased approximately 2.8 million shares. We see real value in our shares at the current market price, which we believe at this low point in the rate cycle underappreciates the long-term margin target of our business. So they believe the stock is cheap and they're buying back stock at 11 times earnings. And I love it. And I love it very much. And I believe they are in a good position to continue doing that, as the company has $8.4 billion in cash and cash equivalent and not much in debt relative to that. So if I look at the company in general, I'm paying around 11 times earnings on the worst case scenario, with call options on many different things, including the states potentially raising their prices a little bit more, including the ACA subsidies potentially being extended. I believe they will be extended going into the midterm. I don't think they're going to just let them expire. So those are two tailwinds. They are not priced in the stock at 11 times earnings. I think the stock is cheap. I see a potential multiple expansion back to 15, 16 times. This is alone like a 30, 35% return, but you also get earnings per share, which the company has grown 18, 20, 22% in earnings per share over the last 5 years. And combined with the bad sentiment and everything around Molina and what the management is doing with buybacks, to me, it looks like a good bet. So I kind of agree with Michael Burry on this one. I believe Molina is undervalued. I like Molina much more than Lululemon and a few of his other picks. It's my best one for him so far. And that was just my opinion on Molina Healthcare. It was not financial advice. So I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.